today's session then, what we're going to be covering are the pros and cons of a limited company. It seems like it's quite a broad subject, and I think there are certainly aspects of it which can be quite broad. I think the thing to say is pros and cons vary depending on each individual circumstances. So there isn't a one size fits all with this sort of thing, but we'll go through a few different topics. My contact details are there as well, so feel free to make a note of those. Any questions once you've had a chance to digest the webinar, want to go back through anything, please feel free to give me a call, drop me an email. More than happy to answer any questions, arrange meetings with anyone. More than happy to do what needs to be done to get you the advice that you need for your own individual circumstances. Okay, so today's session then, what we will be covering, firstly, who can actually be a limited company, what the pros of a company are, what the cons are, and then other factors to consider before making that decision. So let's jump right in. Who can be a limited company? Basically, anyone. So anyone can incorporate a limited company. I could go and incorporate a limited company. You could go and incorporate a limited company. It's relatively straightforward and easy. You can just protect the name by setting up a limited company. So if I want to go and set up George Crowe Limited, I could absolutely go and do that. I just need to register the company with Companies House. They are bringing in more stringent identity checks and needing to put, for example, an actual email address in the system. But as long as you can pass those checks and are able to set up the company, anyone can set up the company. The difference is, despite you being able to set up a company, you might not actually be able to use it. So whilst you've got the company, you can't use it in every single circumstance. We'll go through different aspects here. So I appreciate we've got people from different areas which will have different focuses for their own individual circumstances. One aspect is the core GP contract, so the GMS, the PMS, the APMS contract holders. Now, you can incorporate and you can have the GMS, PMS or APMS contracts through a limited company. So rather than the more traditional partnership model, you can actually incorporate and put that through a company. Now, there are restrictions to being able to do that. For example, if we look at the GMS contract, companies can hold the GMS contract only if the company is limited by shares rather than limited by guarantee. The company itself must have at least one share, which is legally and beneficially owned by a general medical practitioner. It must also have any other shares owned by a medical practitioner is legally and beneficially owned by a general practitioner or medical practitioner employed by the NHS, by an NHS trust, for instance, and any other shares which aren't owned by a general medical practitioner or other medical practitioner must be owned by individuals falling within a specified list. That list and who can actually access them, who can actually be registered to hold the shares, can be found on BMA Law. I can arrange for the link to that website to be sent out to all of you as part of the feedback and part of the follow-up from this session. So I'll arrange for that to be done. I'll get that link sent over to our team so that comes out to you all so that you can have a read through of the relevant BMA Law article, which covers off of that. Now, one thing to state with GMS, PMS, APMS contracts moving over from the traditional partnership model into a company is that contracts are non-assignable. So you can't just say, I'm going to set up a company and I'm going to transfer my contract into this limited company structure. Because they are non-assignable, what that means is you have to first terminate the contract and then a new contract is awarded. That process is known as a novation of contracts. That means that you've got to look at other contractual terms if you go down that route. Now, in terms of other things to consider, you may have premises within the current partnership structure. You may have, you may not own the premises. You may lease the premises. The lease will come with a contract. Can that contract be moved over to the company? Is that within the lease terms and agreement? Staff, the staff will effectively cease their employments with partnership and would then join the company. So there's a TUPE agreement that would need to be entered into. It all forms part of this, and they're all different things that you would need to consider before you can then decide that that is actually the right route for you to follow. So don't just sort of blindly do this. There's a lot of things to factor in before you actually get to that stage. LLPs, companies limited by guarantee, and publicly owned companies cannot hold GMS or PMS contracts. So like I say, those companies that are able to hold those contracts have to be limited by shares, not limited by guarantee. Now, just looping back to the anyone can incorporate a limited company, maybe you don't want the GMS, PMS, APMS contracts to be within a company. Maybe you aren't even part of the GP contracts. Maybe you are a hospital consultant and you're looking to do your private work. Maybe you're a GP and you're looking to do your out of hours work through a company. That's where you can use your own personal limited company to do that work. Now, you've got things to consider with this as well. IR35 is probably one of the main ones. So IR35 is an off-payroll working arrangement. So IR35 basically considers whether the engagement is actually an employee-employee relationship rather than a business employing another business to do work. In terms of the indicators to do that, you've got things like personal service. So can you delegate that service onto someone else if you can't fulfill the work, fulfill the obligation? You've got the mutuality of obligation, control, substitution, equipment, financial risk and reward, length of engagement, employee benefits, and contract termination. There are loads of things to consider depending on each circumstance. Now, IR35 has obviously come to the fore more recently, certainly over the last few years, 5 or 6 years. It's not necessarily for you to determine that as the individual operating through the company. It's for the engaging authority to determine. So they will do things like use the check employment status for tax tool, which is available on the HMRC website, and they will run through that test to put through the particulars with regards to the engagement, and that will then determine whether or not IR35 applies and whether you are able to operate through your company, or alternatively, whether you should be put on the payroll as an employee. So normally things that strike up these sorts of conversations are you entitled to sick pay? Are you entitled to holiday, for example? They're obviously key things to do with employment. So as a self-employed individual, you don't access those through the employer. If you want to go on holiday, it just means that you don't earn the money for that period of time. So, if you've got that benefit of being paid whilst you're on holiday or being paid whilst you're off sick, then that may well look like an employment, and therefore IR35 may apply. That's just an example. It's not necessarily a definitive list. There's other things, as I went through, that can constitute employment. But IR35 is certainly something to bear in mind when you're considering utilising a company for work that you may be doing, private work through other organisations. Okay, so that covers who can be a limited company. Now, why would we want to set up a limited company? Well, the pros have certainly dwindled over the last few years with recent tax legislation that's come in. They have become a lot less tax beneficial. Doesn't mean that there aren't possible tax savings. absolutely possible tax savings are, tax savings are possible, but that depends entirely on the structure and what process and how much income you want to extract from the company on an annual or intermittent basis. The main pro of a company is flexibility. So flexibility in terms of when you withdraw the money. So therefore, when you pay personal tax on that income. As a self-employed individual, you will earn that money, and regardless of whether you want to spend it or put it into a bank account to effectively grow or invest it, whatever you want to do with that money, you're going to be taxed on it. As a company, the company will earn the money, and yes, the company will pay corporation tax, but as an individual, you may be paying 40 or even now 45%, with the change of the tax band being 125,140. Any earnings exceeding that figure being taxed at 45%. You'll also pay class 4 national insurance contributions on it. So actually, it may well be tax beneficial to put it through a company. If you don't necessarily need to access that money, putting it through the company may pay 19% or up to 25% on that money that it's earning, the profits that it makes, whereas you would be paying 45% plus class 4 national insurance contributions. So in terms of having the flexibility about when you take that money out of the company and when you pay your personal tax liability on that income that you're earning, is a big draw. It's something that people like to be able to use and like to be able to flex as and when they need it. Of course, when you do eventually withdraw the money, you will be taxed on it, whether you withdraw that as a salary or whether you withdraw it as dividends. There will be tax due on it. As I mentioned, tax rates and tax benefits have been reducing for a company. So 2 years ago, dividend allowance was £2,000. It's currently £1,000. It's going down to £500. So you can quite quickly see how even that small allowance where you could withdraw money tax-free from a company, that's being really squeezed. So actually, the tax benefits of having a company and a corporate structure aren't as worthwhile as what they were even 2 years ago. So if you're thinking, I'm going to incorporate a company because it's going to save me loads of tax, maybe a few years ago, but possibly not now. Like I say, it depends entirely around when you want to and if you want to withdraw that money from a company. If you don't want to withdraw any money from a company and you want to let it build up and build up and build up, then there's potential tax benefits arising from it. And equally, if you've got lower earning spouses and or family members, so children, adult children that you can give shares to and distribute money to them, then again, it may well be beneficial because rather than you paying 45% or 40% tax plus class 4 national insurance contributions, if you're putting the money through the company's paying 19% tax, for example, and you're then withdrawing that money to a lower earning or no earning spouse who's got their full personal allowance, their full dividend allowance. Yes, you'll pay tax on dividends that you receive, but you can quite easily see how that is tax beneficial in terms of being able to extract profit from a company. So it can still be beneficial, it's just less beneficial. The other main draw of a company is limited liability. Now, obviously, you all have your medical defence subscriptions, which protect you, but limited liability protects you from having any claims brought on your personal assets. So as a self-employed individual or a partner of a partnership, effectively there is no limit to that liability. If they wanted to and there was due course for being able to, they could come after your personal home, your car. Your personal assets aren't outside of the ring that can be captured by a lawsuit. As a limited company, you benefit from that limited liability. So anything that is within the limited company is within scope. Anything that is outside of that, so your personal assets, are not. So limited liability is a big thing and something that we see a lot of people want to use. And one of the reasons for them setting up a company is because they want to benefit from the limited liability. There's a couple of other points on there. increasing state pension entitlement for a non-working spouse and or family member. So if you've got a non-working spouse that isn't in receipt of child benefits, they won't be getting a state pension credit. Through the company, you can employ them and pay them a small salary so that they then get the state pension entitlement. The only thing that you need to make sure that they are doing is working for the company and doing something for the company's benefits. Now, that can be something as simple as maintaining the company records for a bookkeeping perspective, dealing with bringing the items to your accountants to do the work for you. As long as they're doing a role and the salary that you are paying them is justifiable, the keyword justifiable, then absolutely it's one of the benefits, because the state pension, it may not be much, but it's worthwhile having if you can access it. And for a non-working spouse or someone that's not getting those state pension credits, it's well worth investing in that to improve the state pension entitlement upon their retirement. The other thing that's listed there is something that we don't really see too much of within the NHS realm. The NHS pension scheme is fantastic, and one of the drawbacks of it is it's probably too good. So actually, company pension contributions aren't probably needed. But if you are out of the NHS pension scheme, or you've got a spouse that's not earning anything else and you wanted to make a company pension contribution to a private pension, that's certainly a way that you can go about doing that. If it's a company pension contribution for a director, that's tax deductible, so it comes off of the company's taxable profits. It's not a payment that's made out of pre-tax. It's not a payment that's made out of your post-tax income, as you would be currently doing for income that you were earning via self-employment. You can make those company pension contributions to drive the profits of the company down, pay less corporation tax, and invest that money in a tax efficient investment for someone that maybe isn't generating a pension pot for them to be able to withdraw on retirement. So it's not something that we see, primarily because at the moment the NHS pension scheme provides such good benefits that making pension contributions for someone that's in the NHS pension scheme would just serve to increase annual allowance tax charges, and certainly previously would have potentially contributed to lifetime allowance tax charges. Obviously, with the lifetime allowance tax charge going, that's not as much of an issue, but the annual allowance tax charge is still around. So it's not something that we tend to see a huge amount of, but certainly it can be worthwhile looking at that as an option for profit extraction, and also tax efficient investment on behalf of people. With regards to sharing the income out between people, now the thing to really drill home here is you need to make sure that the structure is correct upon setup. So the things to consider are share classes. You've got different options. Ordinary, which is everyone owns the same share class, everyone has the same rights, or alternatively lettered. So if you've got the example of a GMS, APMS or PMS contract through a company, the chances are you're probably going to want to use lettered shares, because if you have lettered shares, that will mean that you can vote varying dividends. You can vote dividends to an A class, which then don't go through to the B class, for example, and you can share the income out better between the people at that point in time, based on their shareholding. It can also vary voting rights as well. So someone with voting rights on an A class may not have, a B class shareholder may not actually have any voting rights and may therefore not be able to make any decisions on behalf of the company, whereas the A class shareholder effectively retains sole control and ownership of the company. So making sure that those are set up correctly. The other thing that I would just mention here with lettered shares is that they are potentially risky. So unless they are used in appropriate circumstances, HMRC can take an investigative view into them. So if you've got husband and wife and you've got lettered shares A and B, husband, for example, is earning all of the income, all of the money that's going into the company, without the company would have been taxed on that money as a self-employed individual, then using the lettered shares to pay all of that money out to a non-earning spouse, that would very quickly attract attention from HMRC, because they are, you're shifting the income from you, a higher rate taxpayer or additional rate taxpayer, to a no earning or non-earning lower rate basic rate taxpayer, simply for the benefit of avoiding tax, which HMRC would obviously have a very dim view of. Shareholders agreements and articles, these need to be watertight, same as a partnership agreement. So you need to make sure that you've got the agreements and articles in place, and they need to deal with everything. Death of a shareholder, for example, what happens at that point? Are existing shareholders given an opportunity to buy shares? Disputes between the company, the shareholders and the directors, how are those dealt with? All of these things need to be covered off in a shareholder agreement, and the articles need to make sure that they are watertight. So just touching back to the previous slide, there are limitations, again, who can hold the shares in the company if it is a GMS, PMS or APMS contract within the company. So sharing income with a lower earning spouse or family members may not actually be possible in that circumstance, but within your own private company, it's absolutely something that you can set up. Okay, so we've gone through the pros. What are the cons? Well, the cons are, we talked about company pension contributions. The cons are you can't actually access the NHS pension. So if you were putting locum income, for example, through a company, and previously you would have been able to complete locum A and B forms to pension that income within the NHS pension scheme, because the company is effectively another individual. So you may have you as the individual and then your company. The company is effectively treated as being completely separate and a separate entity. The company cannot be within the NHS pension scheme, so it cannot pension the NHS income via a locum A or B form. If the company holds the GMS, PMS, APMS contract, you can still pension that income, but only on what you extract from the company. So whether you extract that as a salary or whether you extract that as dividends, that's how you then pension that income. The company itself doesn't pension the income. The locum income, if you extract that via a salary or dividend, you still can't pension that one. More complicated than a sole trader? A lot more complicated than a sole trader. There are a lot more administrative requirements that need to be completed for a company. So as a sole trader, you complete an annual tax return. That tax return needs to be submitted to HMRC, if by paper, by 31st of October following year, or the year of the tax return, or 31st of January if it's an electronic submission, which most of them are nowadays. As a company, you've got loads more that you need to do. You've got the annual confirmation statement. You've got a register of persons of significant control. You've got to complete a full set of accounts, at the moment a filleted set of accounts, a corporation tax return. There is a lot more that needs to be done throughout the course of the year, and a lot more of that information is freely available. We'll come on to that in a second. But in terms of dealing with the company itself, there is a lot more to deal with on an annual basis, and that means that associated accountancy fees are a lot higher. So in terms of what you're looking at for a sole trader, it may be 3-4 times higher for dealing with a company, simply because of the amount of work that's involved with preparing all of those relevant financial statements and keeping the relevant bodies, Companies House and HMRC, up to date with everything. So it's not quite as simple as a sole trader, unfortunately. So it does need to be considered that actually increased costs as a result of dealing with the company are inevitable. We went through the setup and the inception, so making sure that those are accurate. If you then need to make changes, if you need to change change share classes from ordinary to lettered, or need to do share reallocations, those things again are costly. Needs to be involved with solicitors potentially to make sure that articles are amended appropriately. So making sure that all of that is set up correctly upon incorporation is very key. And again, we would recommend you speak to a financial advisor or a solicitor, or indeed us, before you go down the route of making any incorporations, because getting that right at the get-go just saves you a whole lot of pain and a whole lot of money as well further down the line. So we went through a separate entity. So it is a completely separate entity. And one of the things that we see people struggle with is getting that correct in their own mind. You earn the money, you go out and you do the work. So you effectively are the one that's running the company. The difficulty that we see is the distinguishment between that money coming into the company and coming into them as an individual. If you're a self-employed individual, absolutely, that money is yours. So you'll pay, you'll pay tax on that at the end of the financial year. If it's a company, you will pay corporation tax on that money, or alternatively be drawn out a salary. And then once you have withdrawn that money, either by a salary or as a dividend after the company has paid corporation tax on that money, that's then your money. If the company is earning that money, it is the company's money. So if you then want to use that for personal purposes, you need to withdraw that before you can then use it. The difficulty that we see is people earning that and then going, oh, I'm just going to use it to do this. I'm going to use it for whatever, repairs on their property, for example. That then needs to go through a director's loan account. That money then needs to be repaid. If it's not repaid, then there are taxes to be paid to HMRC. It just gets a little bit messy. So having the clear distinguishment and making sure that you've got clear lines between what is the company's and what is yours individually is key. So making sure that upon inception of the company, you've got a company bank account set up, just so that you can properly distinguish everything that's going through the company is invoiced in the company's name, not yours personally. So any invoices that it sends out, company's name rather than you. Any invoices that it's receiving, company's name rather than you, rather than come to you. Obviously, if you are making payments for the company, so there might be things that you use, you might need to go traveling, so fuel, train costs, etc., that you pay for personally out of your own personal account rather than the company's account because for whatever reason it didn't go through the company account, absolutely fine. Those amounts can just be reimbursed to you. But if it's the other way round, you need to make sure that you are reimbursing that money on a timely fashion or in a timely fashion. Possible tax disadvantages. So there's quite a lot that has changed. I went through the dividend allowances reducing from £2,000 down to £500. In terms of corporation tax rates, previously they were at 19%. Regardless of what your earnings were, they were at 19%. Now there are different rates. So if your profits are between £0 and £50,000, you'll pay corporation tax at 19%. If your profits fall between £50,000 and £250,000, you'll pay tax at 25% or a marginal rate. And if it's over 250,000, it will be at 25%. So if you've got a very profitable business and are then going to withdraw money from it at the additional rate as a dividend, you'll be paying 39.35% tax on the majority of the dividends that you withdraw. That can actually end up being a tax disadvantage to you after having factored in the company paying 25% and you then paying the additional rate of dividend tax. You can see that actually 25% plus 39.35% may well actually equate to more than the 45% plus class 4 national insurance contributions that you otherwise would have been paying. So actually a company is possibly not tax advantageous anymore. The other things to factor in are associated company rules. So it previously was groups. So if you had a group of companies that were all owned within the same group, then you would share tax bands. Those rules are still in force. So if you have got a group of companies, then that is still in force. However, now you've got associated company tax rules in there. So if you've got a company that is associated with you, whether that be through use of the same premises, use of the same staff. So the example that I give here tends to be if you've got a partnership and you've got 5 GPs, and all 5 of those GPs then do private work outside of the practice, but they use the practice premises, they use the practice staff, and they do all of that through the shared location and shared premises, using the shared common resource, then they're associated. What that means is those limits that I just went through, the 50,000, 250,000, are then apportioned down based on the number of associated companies. So rather than it being 50,000 and 250,000, it's all of a sudden 10,000 and 50,000. Well, actually, that's a big change. All of a sudden, someone that's earning £50,000 is no longer paying 19%, they're paying 25% corporation tax, and then extracting money from that company. So actually, that's another tax disadvantage that was recently brought in. And the other thing is capital gains tax. So we talked about leaving money in the company to build up over a period of time. If we leave the money in the company and then we get to the end of the useful life of the company and we want to liquidate it, we want to strike it off, that is a disposal of your shares in most instances. There are some instances where it isn't, but assuming that it qualifies as a capital disposal rather than an income distribution, that is taxed as a capital distribution. That means it's taxed under the capital gains tax regime. And again, they've sliced the limits. So currently, £6,000 of tax-free allowances before you then end up paying capital gains tax on any gains. That's now going down to 3,000, and of course, after that, you're then paying tax at the rate, a capital gains tax rate. Those capital gains tax rates are actually tax beneficial compared to what you would be paying as an income. So went through 39.35% for an additional rate taxpayer for a dividend. It's 20% for an additional rate taxpayer as a capital gain. So it can actually still be a beneficial way of doing it, but this comes back to how flexible you need to be with withdrawing money on a timely basis, and what sort of structure you've got in place to make use of the available allowances, whether that be the dividend allowance, whether it be the personal allowance, or whether it be capital distributions and the capital gains annual exemption available to you. So, as I said, it's possibly tax advantageous, it's possibly not. So it doesn't follow that one rule for one person will be exactly the same for another person. It's highly individual. The other thing as well now is that information is publicly available. So there's always been some information available with Companies House. You could always see directors' names. You could always see the company names, the company registered office. There are reforms going on at Companies House, and they are implementing more stringent checks. They are going to bring in different rules in terms of what needs to be filed with Companies House. And actually, the amount of information that's publicly available is going to increase. So, for example, next month, there's going to be new rules implemented for registered office addresses. You're going to need to supply a registered email address, and there's going to be new lawful purpose statements. So you have to say that the company is going to be set up and run for lawful purposes or within lawful purposes, not for anything unlawful. And you'll have to make that declaration. The major future change which is coming is to do with what is filed at Companies House in terms of accounts. So at the moment, companies file a filleted set of accounts. That filleted set of accounts means that you file the company's balance sheet alone. So there aren't any figures in terms of what the profitability of the business is in that year. And you can, so the balance sheet gives an indication, but it doesn't say in black and white terms what the position is, because they might have extracted dividends. It doesn't split that out in terms of how much profit a company is making. The change that's coming is filleted accounts won't be a thing. It will be a full set of accounts, and you'll be filing detailed profit and loss accounts which set out your income and your expenses, and everyone will be able to go online and see what those are. One of the reasons that a company is quite nice is because of the limited liability.
but also the fact that the information isn't publicly available. Obviously, with your self-assessment tax return, that information isn't available at all. If you have a company, however, that information will soon be publicly available, so it loses that anonymity that you currently are afforded by Companies House. A couple of other things there as well is bank borrowing can be harder and can be more expensive. So I mentioned that the company is effectively a separate entity, a separate individual. The company will have less things available to it to secure loans against generally. So bank borrowing can be more expensive. Companies, lenders may seek to set up other securities so that they aren't going to be left out of pocket if the company fails to repay its borrowings. So it can actually be quite hard and more expensive to borrow through a company rather than as an individual. And joining and leaving a company is a lot more complicated than a partnership. If you want to leave a partnership or indeed leave a self-employment and stop doing it, absolutely fine, you can do that. If you want to leave a company, you've got to effectively dispose of your shareholding. You've got to resign as a director. There are more hoops to jump through. The company has a value, so if you want to be bought out of a partnership, you are paid out of your current account. If you want to be paid out of a company, the company may need a formal valuation. It may need authority from HMRC, depending on what way you go. If you go down a purchase of own shares option, it's a lot more complex to leave and to wind up a company than it is within the current more traditional partnership or self-employment route. That's not to say it can't be beneficial. We talked about the fact of paying capital gains tax as opposed to income tax, so 10% or 20% at the current capital gains tax rates. That can actually be a tax benefit. They are more expensive to go down those routes in terms of liquidating a company, but the tax benefit is potentially there in those circumstances. Okay, so we've gone through the cons of a company. What else do you need to consider before you actually make that decision to jump into being a company? Well, first off, you need a longer term plan. You need to know that this is something that you are getting into for a sufficient period of time. Sufficient period varies depending on each individual, but it shouldn't be something that you just enter into and go, oh, I'm just going to do this for a year, because we've talked about how much harder and how much more expensive it can be to liquidate a company. So if this is a short-term plan, then it's not something that you perhaps want to enter into on a whim. It needs to be something that's carefully thought about in terms of going forward. Is this the right structure for me? Is it the right structure for the business? And therefore consideration needs to be thought about rather than it just being purely financial aspects making that decision. The longer term plan needs to be thought about. Associated companies. So we talked about associated companies and being those affecting the corporation tax rates. So rather than them being 50,000 and 250,000, it can also bring you into quarterly payments, quarterly instalment payments. So if you've got a large group of you that work and do private work together, and you're all operating through a limited company, for example, well, you're all doing the same work, you're all financially independent, you've got the same customers, you've got the same suppliers, you use the same resources. Those sorts of things would make you associated, and that can actually increase the tax liabilities that you're paying, can actually accelerate the tax payments that you're due to make as well. IR35, we talked about IR35, so I'm not going to cover that one in too much detail again. It's just something that you need to be aware of. This is where a company may not work for everyone, depending on the specific circumstances of the engagement. Marginal tax relief. So this is where you fall into that marginal rate of tax, so between £50,000 and £250,000. That marginal tax rate can actually be more than 25%, depending on where you are within that spectrum. So actually, increasing your profits to a level of over 250,000 may be beneficial. And equally, if you are just at the bottom end of that, £50,000, for example, if you're at £55,000, trying to see if there's other expenses, things that you can put through to actually bring you down, and understanding where you are on an ongoing basis. Obviously, after the event, there's nothing that you can do. But if you're getting towards the end of the tax year, is there any way that you can invest in something that will bring your profits down to a lower level so that you aren't in that marginal tax rate? Marginal tax relief is something that you need to consider, particularly if you are at either end of that spectrum within the 50,000 and 250,000, or tapered allowances, depending on if you've got associated or group companies. Trading versus investment company. So this is purely the distinguishment between whether the company is classified as a trading business or an investment business. An investment company is deemed to be a company in which more than 20% of its assets are held as investments. So that can be a simple thing as having money in the bank, in a savings account, which is generating interest. A company which is generating more than 20% of its income from investments, more than 20% of expenses relate to investment management, and more than 20% or more than 20% of the directors' time is spent dealing with those investments. So if you qualify as a trading company, the main thing that this enables you access to is business asset disposal relief. So one of the rules and requirements of being able to access business asset disposal relief, which means that upon liquidation, you would pay capital gains tax at 10% on gains up to £1 million, provided you've not used any on any other assets in your own circumstances beforehand. If it's, however, treated as an investment company, then you aren't able to access business asset disposal relief because you haven't been classified as a trading company for the 2 years prior to liquidation and winding up and cessation of the company. So it's just a little distinguishment. It's not the be all and end all, and indeed leaving money in a company which is accruing very little may not be the best way to deal with things if you're just purely trying to keep it as a trading company, particularly if that decision about liquidation and winding up isn't going to be happening for the next foreseeable future. So again, speaking to a professional and understanding what your options available are is important. Transferring property. So if a surgery, GMS, PMS, APMS contract is transferring into a company, if you need to transfer the surgery premises into the company, for example, you need to get prior agreement from NHS England that that's able to happen. If it's just a standalone company, if you were incorporating a property investment business, for example, and you were wanting to put all of your rental properties through the company rather than holding them in your own name, if you do it that way, you as an individual have to sell those properties, and the company has to acquire them. So there are costs involved, stamp duty, land tax, for example. You may have capital gains tax to pay on them personally. It's tax inefficient in the most instances, putting property which is already in situ into a company, and indeed buying, as we went through, borrowing can be hard to access. Share valuations on member changes. So we talked about a partnership and partners joining, leaving. If you've got people that are perhaps wanting to increase their working commitment and needing to be given more shares, or if you have got the example of people joining or leaving, share valuations may be required to identify the value of the company that is attributable to their current shareholding, and how much additional shares to issue would be, to purchase, to buy into the business, how much they would be to sell, and how much they need to be bought out. Like I said, there's different ways of going around the buyout purposes. So it can be a purchase of own shares, other members can acquire them, new members can acquire them. It depends on what the circumstances are with that. But understanding what the valuation is at that point in time in which you want to value the shares and need those member changes to happen. The valuation isn't necessarily a cheap thing to do, so it's not quite as flexible as the current partnership model that we see on the majority of GP practices. And the key thing there, speak to a professional advisor. This is all stuff that your advisor should be able to give you input on, should be able to help you with. It may not be all under the same umbrella. So if we're talking about investment advice, you might need an independent financial advisor. If we're talking about share articles changing or share reclassification, then you might need a solicitor. Accountants, you know, we obviously deal with companies in terms of a financial perspective, making sure that the compliance work is done, understanding the structure as well and making sure that that's correct at the setup. That's all stuff that we can be involved with. So before you go down any route, always make sure that you seek financial advice and seek professional advice, because it's very costly to change it. And the worst thing that you can do is go, I've done this. And then you speak to someone and say, why did you do that? That's not a nice conversation for anyone to have and anyone to be involved with. So just making sure that you understand what the situation is before you go ahead and do it, and seeking out the relevant advice from the relevant people is key. Okay, so that covers all that I had to cover. Just loading up the question box. So if anyone's got any questions, please do feel free to fire away. More than happy to answer anything that anyone has. Appreciate there's a fair amount that we've sort of covered today, but hopefully that's what goes through the majority of things that people were asking about. Yeah, so if you have any sort of income and you were working as a locum, for example, and you were wanting to pension that income within the NHS pension scheme rather than via a company, if you had operated as a company for a while and then wanted to all of a sudden stop being a company and move back into being a self-employed individual, that then poses other issues. So there is targeted anti-avoidance in those aspects. So if you wanted to do that, you can't then liquidate the company and take that money out as a capital disposal. So one of the targeted anti-avoidance rules is called anti-phoenixing. And effectively what that means is if you liquidate the company and then from the ashes of that company, you then come back and do the same sort of trade or a similar sort of trade, and then continue to do that, rather than it being treated as a capital disposal, that would be treated as an income disposal. So actually it's then very tax inefficient to do it that way. So this comes back to my point about needing to make sure that it fits in with the longer term plan. If this is going to be a short term plan, something only for a couple of years, or something that you're going to want to use as a vehicle for a few years to then go back into it in a self-employed state, that doesn't necessarily work, particularly if you're then wanting to do that from a self-employed perspective or through another company. One of the things that the reason that they brought this in was because people were building up a lot of distributable reserves in a company, and then they were extracting the money as capital via the liquidation route, and then reforming a very similar company, and then taking money out again when that then built up. So they were getting it out in a tax efficient manner rather than it being a case of actually a legitimate purpose. So yeah, if you need to stop doing work through a company for whatever reason, but we're then looking to do work through in the same sort of similar business activities, that you can't actually do that. Well, I'll leave you all to enjoy the rest of your days then. But like I say, feel free to digest the information that we've gone through today. And if there are any questions, please do let me or another member of the team know. We're more than happy to help you. As you can see there, we operate across 6 offices in the location. So we act for 6,500 clients. We've got a wealth of knowledge. If you need us to assist with anything, please do let us know. And yeah, I will hopefully speak to a few of you soon. Thank you.